Welcome to the Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, passionate investing community. And we'll be celebrating the release of Passionate Living Through Passive Investing soon. Here's a quick reminder to go out and find our free Facebook community online. And as you know, capitalizing on hidden opportunities is very important to our approach in the passionate investing community. And build to rent is something that most people don't know much about, and as such, represents a huge opportunity for those who are in the know. So today I have the pleasure of interviewing Arn Cenedella, who is here to talk about the topic of why invest in build to rent. So with that, I'd like to welcome our guest to the show. Welcome, Arn.
Hey, George. Great to be here. Looking forward to having a good chat with you.
And as always, and we did this a couple months back. I don't know when this one's actually going to drop, but you're one of the guests that I think is definitely interesting enough and involved in diverse enough investing operations to have back for a second. And I do like to focus. And so today our focus is going to be build to rent. And if you could just give us a basic idea of what's going on with build to rent. I think when most people think of building, they think of building to sell, and rightly so. A lot of this product ends up going to a retail consumer, but build to rent is really another very interesting and I think very valuable approach to real estate investing. So what does build to rent mean to you?
Yeah, so build to rent is purpose-built developments or communities where the goal is to rent the new buildings that are being built. So as opposed to D.R. Horton building 30 new homes that they're going to sell to retail owner occupants, D.R. Horton could build 30 townhomes with the intent to sell them to an investor. So it's basically new construction, but not with the intent to sell the owner occupants, but rather to sell to investors who then have the intent to rent those properties and hold them long term. So it's kind of like multifamily in that there's a lot of units, townhomes, units, residences on one property, and they're all rented and operated by the same owner.
Yeah, that's great. And there are some advantages and some differences between the owner-occupied model. For example, a lot of people would say, hey, you're going to go for those single-family homes. I like the analogy to multifamily because in a way it is like that. You're buying a whole bunch of units at once. Some people call it horizontal multifamily. I like that metaphor. But to get back to, what makes a good rental unit, it's not necessarily the same thing that most people are building these days. My family's in construction and we're building upwards of 2,000 square feet. These are very large, semi-custom homes with a lot of bells and whistles. You can talk to the builder and get exactly what you want. But here, like you mentioned, there are some differences, right? In your case, you're looking for townhomes, for example. That's something that does tend to lend itself, I think, a little bit better to the rental community, sharing a wall, sharing some construction, making it a little bit cheaper to build, maybe a little smaller. Another thing I think of when I think of build to rent is a lot of times you have amenities, which is another great parallel, I should say, to multifamily. Sometimes there may be some community focused things like swimming pool or clubhouse, etc. So, well, what for your build to rent? What sort of things are you focusing on?
Yeah, so it's a great question. And I particularly like how you started out kind of mentioning the size of the buildings being built. So for us, we like to rent at a relatively affordable rate, kind of a middle income, working class rental rate. And in order to make that happen, the units themselves have to be smaller. in the Greenville market, $1,500 a month rent is affordable. We're not looking to buy 2,500 square foot homes that we can rent for 2,500. That's not
Right.
the game plan. We like to buy smaller units where the rent is affordable for a large percentage of the population. And so in our market, we tend to like buying 1,200 square foot units, which are decent size. If they're 2-story, they're typically 2-bedroom, 2.5 bath, which is a popular configuration for a lot of people. We also have some 1-story units, and those they're typically 3-bedroom, 2-bath, maybe about 1,200 square feet. So we like it kind of 11, 12, 1,300 square feet in our market is kind of an ideal sweet spot. And they're still high quality. We get granite counters, we get luxury vinyl plank, but typically the exterior is vinyl, it's slab construction. And the other thing I would add is the projects we generally buy are smaller, so they're not really large enough to support a pool. So our common areas amenity would typically be like a dog park or a picnic gazebo barbecue area. That's kind of the level of amenities we provide, because most of our projects are kind of between 20 and 40 units. And really, to get a pool and make it somewhat economical, you generally have to get well over 100 units to make that work. So ours are smaller, and it kind of fits with the existing assets we buy. Most of our assets are 20 to 50 units. We like that size, and that's kind of the size build to rent products we've been buying too.
And what sort of per unit are you able to get when you're charging, say, $1,500 per unit?
Yeah, so we're paying between 165 a door and 175. And so if you break that down on a price per square foot basis, we're paying about $160 a square foot. So for us, we feel that's a very attractive basis because I'm sure most of your listeners probably live in areas where builders might charge $200, $300 a square foot just for the vertical, not to mention the land and the infrastructure. So for us, and in Greenville, I would say average quality construction, single family home might be 200 a square foot vertical. So when we're able to buy units at $160 a square foot all in, we just feel that's a really good long-term basis. So we love buying that type product. Operational expenses are low. We don't expect any major maintenance for about 10 years. And of course, if you're a tenant, a prospective resident, who wouldn't love moving into a home that's never been lived in, that's brand spanking new? So they're easy to rent. You tend to get a little bit of a premium. So we kind of like the whole model.
Yeah, and it is a bit of a hybrid model. I mean, you are obviously catering to renters, but at the same time, the tenants, they're getting a high-end product and some of the other great things that you get with being a tenant. I mean, you may or may not have your own walls, but if it's a townhome, right, you got your own entrance. Somebody else is cutting the lawn. Appeals to a lot of people, including maybe older people who don't push that lawnmower. I mean, I'm not even considering myself older, and I haven't pushed my lawnmower in years. It's just good to get out of the habit of doing some of these things.
Yeah. And we're, people who follow the multifamily space, one common theme that we're seeing is more and more individuals with fairly good incomes, fairly high incomes, let's call them renters by choice. They have the financial wherewithal to buy, but they choose as a lifestyle decision to rent. And so the average income of many tenants in the US is going up. And so they expect like kind of a newer, nicer, higher quality product than perhaps some other tenants that are paying kind of a lower rent. So I think there's a trend away from home ownership towards renting in the US right now. And a lot of that is in the renter by choice. And so they want to live in a nice property. They want to live in a new property. I mean, some of the advantages is up-to-date insulation, modern heating and electrical systems, open floor plans. So you get a lot with the new construction that in your typical apartment that could be 30, 40, 50 years old, you're not going to get. And so our residents appreciate that.
Yeah, and a lot of advantages, like I was mentioning, it's not just for people that don't want to have to cut the lawn. You have to move often for your work. Being a tenant helps. And again, yes, certainly among the more affluent, I think renting is a bit of a trend. Another great thing is when rates come down, and we just did have that half-point drop as we record this. That was the middle of last week. We don't expect to see that mortgage rates, and they already have come down quite a bit. I follow this every week. Ladies and gentlemen, go to the primary mortgage market survey. If you want to survey residential, comes out every Thursday, comes out from Freddie Mac. And you can see that that's just been dropping like a rock, because we all knew the Fed was going to do this. And I think a lot of people that do have the means to buy, they're kind of waiting out the market. They don't mind renting for a little while. And when the home prices come down, or I'm sorry, when I should say the cost of ownership comes down, because it's really the financing price. Very few people are buying that house for cash, unless maybe you're an investor and you're going to flip it or something. But your retail owner-occupied buyer isn't really doing that, and I think maybe some of those people might move on. Interesting to see how that trend shakes out. But really, that dovetails with my next question, which is, how do you see the multiple exits with build to rent? I mean, for me, that's one of the best things about the build to rent space. I mean, obviously, you can, as you do, buy them 20 to 40 at a time, rent them all out, but you can do other things as well.
Yeah. So oftentimes, so we've primarily bought duplex product, meaning two residential units in one building. They're typically side by side, not upstairs, downstairs, side by side. You have one common wall. And oftentimes each duplex has its own tax map, meaning the duplex could be sold individually. So one of our potential exits, 5, 10 years down the road, say we have a development, we own one with 13 duplexes, 26 doors, 13 duplexes. Down the road, we could choose to sell off each duplex independently to a retail buyer, often somebody who might want to live in one unit and rent the other. And for a first-time buyer, that's a great way to get into the market. You get low money down, 30-year fixed rate debt. So having the duplexes on separate parcel numbers or tax maps, depending on how it's defined in your area, provides another exit option. So that's one. Or we sell the whole thing to another investor. We'll just have to see what happens down the road. But there is that additional exit that would be different than if you owned a 30-unit apartment building. I guess you could go condo and then sell them off individually, but I've been through a few condo conversions in my day, and they're a lot of work, and particularly on older product, it doesn't really work too well.
Yeah. Yeah, well put. I would say that's a huge reason to go for the build to rent. Well, another thing that I noticed about your approach is that you are buying existing build to rent, or that is to say that you're not doing the construction, you're not investing in the construction phase. You wait until it's built, and that's when you jump in. So tell us why you feel that that's the best approach for you.
Yeah, so it may not be the best approach, but I like it because number one, I'm more an investor than a developer. So I don't have any experience doing ground up development. I have lots of experience running rental property. Uh, Construction is time consuming. You're paying on a construction loan. Sometimes the entitlement process can get a little difficult and time consuming. You own the land, you're trying to get it entitled, and it's dragging on months after months. Construction costs can vary. You can have supply chain issues. So primarily for me, I'm an investor. That's what I've done for 40 years. I'm not a builder developer. And so I feel more comfortable in the space buying completed units at a fixed price, negotiate it with the builder, and not having to get into some of the hassles building new construction. I've probably done 10, 15, 20 flips in my day. I think most investors at some point have tried to do a few flips. And I bet almost all of those people have had frustrations getting the contractor or the subcontractor to show up, get the work done. What's the price? Why is there an added on charge? So for me, setting the price with the builder, agreeing on the price, not having any of the headache of getting it built and just buying it when it's done, for me, it's what works best. That being said, at some point, maybe I would do a smaller ground up development, but I'd have to have a contractor partner that I knew, that I really trust, that I had a prior relationship with. And at some point, maybe I'd try it, but again, it would be smaller scale. I'm at a point, I kind of have a model that I do, and I'm at a point in my life I don't have to take huge risks. So my investing typically tends to be conservative, and buying existing product fits with that, albeit going from ground up to completion. Sometimes there's some greater profit. I'd rather reduce the profit and reduce the risk and the hassle of getting it done.
Yeah, beautiful. And you definitely do take a lot of the risk out, a lot of the headache out, as you mentioned. And I think that's really smart. I think investors, you really need to know where you fit in the ecosystem, what sort of headaches you want to take on. Because if at a certain point, if investing isn't fun, if this doesn't fill your cup, then you're not going to be happy, and it's just not going to be a good situation. But I'd like to take maybe even one step back from there and ask you what brought you to build to rent, because I know you've done a lot of things, including multifamily. A lot of people don't even think of build to rent. So what attracted you in the first place?
Yeah, so that's a great question. So most people in the multifamily space understand that transaction volume the last year or two is probably 75% less than it was back in 2019, 2020, 2021. And that's primarily due to the increased rates. So my first 4 or 5 deals were kind of traditional multifamily, buying existing product. But as most investors have found now, hard to find a deal on an existing property where it pencils and makes sense. The seller wants 2021 prices. The buyer has to pay 2024 debt rate, and it just doesn't work. And if you think about it, say somebody owned a building that they bought 5 years ago, 4 years ago, because oftentimes these buildings turn over every 4, 5, 7 years, just as a rule of thumb. So if somebody bought a building 4 years ago, 2020, they probably have 4% debt on it. I know a few of the properties we bought back in 2021, we got 4% debt. So you have an owner, they have 4% debt, it's producing a certain NOI, and now I'm a buyer and the guy wants to sell the property. Well, as a buyer, I have to pay 6% now for the debt. And so it's the same NOI. So the property's actually worth less to me having to pay 6% debt than it is to the current owner who is paying 4% debt, right? Same NOI. The guy who owns it's got a big cash flow. If I have to buy it at that price and pay 6% debt, I got next to nothing cash flow. So the truth is that property is worth more to the seller than it is to me. I might pay 2 million. To the seller, it's worth 2.5 million because they got 4% debt. So the increase in the interest rates have created a situation where the value of the existing property is more to the existing owner than it would be to me as a new buyer. And so wanting to do deals, wanting to acquire property, wanting to provide opportunity to my investors, I kind of started thinking, well, who's the most motivated seller in this market? And I would submit the most motivated seller is a builder, right?
Right.
A builder builds, they sell, they take their profit, they go on to the next track. That's what they do: build, sell, profit, move on. And so they're not long-term hold investors. They're not building to hold them as rentals. They're building them to sell. So we started approaching small local builders who we knew were building townhouses or duplexes. And we said, hey, we'll buy all 20 of them. What do you think? And for us, maybe we got it at a slight discount from retail. So we bought maybe a little below market. But for the builder, think about it. If he had 20 buildings, he sells them to us. He's got one escrow, one closing, one buyer to deal with. Boom, done. If he sold them individually, he'd have 20 separate transactions to go through.
Right.
All with their own financing. So there's some advantage. Time is money, and it's aggravation. And so for builders, if they can sell their entire inventory 15 days after it's complete, that's worth money to them. So it's actually a win-win. We buy inventory at good price. They close out their project, they make a profit, and they move on, and there's kind of no drama. So that's why we got onto it. But I'm still looking for existing assets, and we just recently got one under contract with seller financing, long-term owner, second-generation owner, owned it free and clear. So we will still buy both. It just matters on the deal and where we can find something that makes sense.
Well, absolutely love it. And, from my perspective, there's a lot there, not just the time value of money. As you mentioned, dealing with, say 20 different investors, if that's what you want to do with your 20 duplexes, I'll tell you, one of them is going to take a lot longer than the rest. So I guarantee selling them all at once is huge. You also mentioned seller financing. That's huge right now. Rates have started to drop. I think we've got a long way to go until we hit bottom or at least stabilize. And assumptions are another thing. You point out how a lot of times a building is just worth more to the seller than it is to the buyer, and the seller just decides to hold on to it. And that's a completely rational decision. But if you've got some great agency debt on there, if you can assume that, and it isn't easy, but I've seen it done, and with the huge delta in rates, it's often worth taking the time, and it's going to take months and months. Some of these transactions easily take a half a year to get that loan assumption properly done. That's very, very worthwhile. So interesting to see how the market is trending. Anyway, I think we're going to have to wrap right now. Just want to ask, have you got any questions for me, Arn?
Yeah. So, George, I know you study a lot of data. You're always looking at markets. What do you think is going to happen in multifamily the next year or two? What's your thought?
So I think these are going to be boom times. I think this is the time that you want to be ready to move. If you're ready to move right now, if you already have your education, hopefully a few transactions under your belt, you've got your partners, your capital ready to go. The people that have the dry powder are going to do very well, because I think the deals that pencil right now in the current interest rate environment, they're going to do extraordinarily well once those things are refinanced down the road. And we've talked a lot about cap rate expansion, but we may very well see some cap rate compression. We may return to the days of some very serious tailwinds to help investors along. So I would say that, again, whoever's ready to move right now is going to be in good shape. If you're still a student kind of looking to get into the business, I'm not going to give you the crazy old advice, just make a deal. It's not that simple. But if something actually pencils and it actually cash flows now, you'll almost certainly be doing much better in a year. So I would say if you're close to being ready to act, definitely go find that experienced partner and continue to underwrite these deals, because I think it's really going to pay off. If you have to underwrite 100 or 200 deals in this environment, you may find yourself in 6 months where a much larger portion of deals are going to pencil, because again, remember, there are some people that are just not going to be saved by the interest rate decrease, and there are going to be some foreclosures, some troubled sellers, people trying to avoid that foreclosure. So I would say just definitely be in position, but keep some dry powder. I mean, it's entirely possible 6 months or a year from now, things will be even better.
Yeah, agree 100%. I'm optimistic about the next year or two. And the other thing I'd leave with your listeners just to ponder, I've always said I'd rather jump back into the market 6 months early than 6 months late. So just think about that, because once the market gains momentum, it's going to be much more competitive as a buyer. I think we're starting to approach that level, and we still may be 6 to 12 months out, but if you want to buy with a little bit less competition, probably moving sooner rather than later makes sense. So that would be my only comment: 6 months early rather than 6 months late.
Yeah, well, I love it. And I'll just quote my favorite Warren Buffett quote about market timing, that if you wait for the first swallow of spring, you're late. So don't wait until it's obvious that spring has come. Get ready to pounce, because you will find the deals, and I do think that the deals will continue to get better. But don't wait until everybody is jumping in the market.
Totally agree.
All right, great. Well, here, before we close, a couple of quick questions. I know we gave you the lightning round last time, but maybe we can just really shake things up a little bit this time.
Oh my
A couple
goodness.
questions which I don't think I asked you, and these are kind of just whimsical, like getting to know you questions. If you could have a wild animal for a pet, what would you pick?
How about like a cheetah?
All right, good. I like that, because I can't stand people that pick something boring. Like, yeah, at least like a chinchilla or a anteater. Cheetah. Cheetah's good.
You
And if you
know,
could jump into
they're lean, they're fast, they're fit, they're aggressive. So I kind of like that visual image. Yeah.
well, that's perfect. And I think that's probably what investors need to be right now. Be the cheetah. And remember that, the cheetah, these big cats, they stalk their prey, right? They don't just try and catch a leaping gazelle. so
Yeah.
so take a little time, even if you think you're the fastest on the Serengeti. Spend a little time stalking that prey. All right, and then maybe will also end up being somewhat related to the market right now. But if you could jump into a pool of anything, what would it be full of?
Uh, I would just say salt water. How's that?
I love it. Yes.
Saltwater
So
pools are great, and it's always great to be in the ocean. So I really enjoy that.
all right, I love it. Well, I gotta say, this is gonna be one of the better endings to my show. I'm like totally geeked. I want to jump into a great saltwater pool of multifamily deals. So,
Yeah,
how does that sound?
it
Or
sounds good.
how about some great multifamily deals by that saltwater ocean? But to get serious, just for one quick second, to make sure at the end that people are able to reach out to you, because that's really what the show is all about, making sure that we make powerful connections here on the Foundry. What is the best way to reach out to Arn Cenedella?
My website is investwithspark.com, all one word. And I'm active on social media, Facebook, LinkedIn, either other Arn Cenedella or my company, Spark Investment Group.
Wonderful. And thank you so much, Arn, for taking the time to share your knowledge and experience with our audience.
Thanks, George. Great to see you as always. Appreciate the opportunity.
Likewise.